As the world grapples with the COVID-19 pandemic, it looks like the worst is over for China. We speak with Patrick Yeo, Chief Investment Officer for Fullerton Fund Management, on his views. Patrick, what is your outlook for the Chinese market?
For Chinese bonds, the outlook is positive. The near-term catalysts are, firstly, the large yield gap versus other developed markets and emerging markets comparable bond markets, with most global central banks already hitting the effective lower bound. The PBOC stands out with policy room to ease further. Secondly, stability of the currency. With renminbi managed against a basket of trading partners' currencies, this lowers the probability of repeating past episodes of capital outflows and currency weakness that has impacted the total returns. But the medium-term catalysts are, firstly, continuation of bond index inclusion. Currently, 2 out of 3 indices, the Barclays Global Act and the JP Morgan GBI-EM, have included Chinese bonds. This is expected to attract 100 billion yuan of inflows this year. WGBI bond index remains the last bond index which could include Chinese bonds. This will attract another 150 billion yuan of inflows. Secondly, structural reforms of interest rates. Policymakers will guide cost of financing via various market-based interest rates and liquidity facilities. These measures are supportive of lower yields and hence stronger performance in the bond markets. For equities, on a 3-month horizon, we remain positive. With COVID-19 largely under control, with mostly imported cases now, the focus has shifted back to stimulating economic growth, and we expect strong sequential growth in the coming months. March total social financing data confirmed that monetary policy is very accommodative and recovery is more likely. Now, the key risk is China export growth, as well as the supply chain disruption for key components. Currently, resumption of production is possible as companies are drawing down their key component inventory. A more protracted than expected pandemic means that key component shortage would have a drag on China's economic recovery.
Would the onshore market likely fare better than the offshore markets this year?
Yes, for both bonds and equities. Onshore bonds would directly benefit from accommodative monetary policy through both lower interest rates and easing liquidity. Foreign inflows into onshore bonds are also likely to be supportive, as China's weight in various global bond indices would continue to rise. In equities, while A-share has outperformed offshore China market, both markets are trading at similar valuation at around 10 times PE. We believe that onshore will continue to outperform offshore China market for the following reasons. Firstly, there's expectation for higher local government special bond issuance quota of 3.5 trillion yuan this year versus 2.1 trillion yuan in 2019. There will also be issuance of central government special bonds to boost infrastructure spending. Secondly, consumption will be encouraged via consumption voucher and electric vehicle subsidies. Thirdly, targeted focus on extending credit for SME is expected too, with ample liquidity in the system. And this is shown by the strong M2 growth of 10.1% in March. This is a 2-year high. This all suggests a sequential recovery in China's economic growth. The offshore market, on the other hand, has higher weightage in new economy stocks that might not benefit as much since these stocks were less impacted. The offshore market also has higher foreign participation, and these investors are generally still more cautious at this point in time on China.
Patrick, on the COVID-19 situation in China, it looks like they have it under control. How does this impact your assessment?
Our outlook remains cautiously optimistic, given that China is the first large economy return to some normality, with growth likely to rebound sequentially in this quarter. Now, while new confirmed cases fell sharply, the risk of a second wave infection through asymptomatic cases, currently there are more than 1,000 of these, could curtail the full lifting of containment measures and hence weigh on services-related economic activities. Impact of global demand slowdown could also weigh on Chinese exporters' ability to rebound quickly. However, policymakers resolved to stabilize growth could see a larger pro-growth stimulus measures going forward in this quarter.
Within the Asian markets, what are the investment opportunities?
We see many investment opportunities in the Asian market, in particular consumer, healthcare, and technology sectors. We believe in the long-term structural trend in consumer sector. In the short term, consumption can rebound strongly on containment of COVID-19. Healthcare is an area which we have a positive view in the long term, even before this crisis. And the case is even stronger now for higher spending in the healthcare sector. The US and China trade war and this current crisis have both affirmed the importance of localization or onshoring. We remain positive on technology sector, especially for import substitution as well as technological advancements.